Good day and welcome to yet another weekly wrap from Brand Swiss. I am with Govender and we're going to cover stories that occurred this week, as usual, that are going to affect you and your investments going forward. Today we're going to cover three main stories. One, what's happening with the Russia-Ukraine war. The second thing is South African inflation. And finally, we'll do a deep dive into what's happening with interest rates. This has been a very active week for interest rates, and it's worth looking at who's done what and why. So let's start off with Russia. As I discussed last week, the Russians appear to be losing some ground in the Ukraine. At the moment, the Ukraine counteroffensive has been extremely successful. Basically, what's happening is what's taken Russia months to achieve. The Ukrainians are basically claiming back in a matter of days and weeks. They've accumulated like thousands of square kilometers of territory. A lot of it is unpopulated, but there have been some significant population centers that they have actually taken a hold of, villages and small cities and so on. The Russians are definitely in the back foot. We are seeing stories out of the Russian media that is becoming increasingly anti-Putin and anti-war. Now, this is very unusual because the Russians tend to have quite a bit of control over the media, and the fact that we are seeing these stories break through has been rather surprising, and indicates that the Putin is on the retreat at the moment in terms of public support. So what has Putin decided to do? He's come up with a speech, and basically he's looking at mobilizing the country to a war footing. At the moment, the Russians aren't quite at war. They are doing a special operation in the Ukraine. So there's a limitations to what they are able to do and what they have actually been willing to do at the moment. Moving to more of a war footing means that they're going to be more aggressive. There's more people going to be recruited. Soldiers, etc., are going to be facing longer tours of duty. More people are going to be dragged in from different parts of the country in order to basically fight in the Ukraine. At the moment, Russia has a choice to make, effectively. With the setbacks that they've seen, they either can retreat or they can become more aggressive. From what we've seen, it appears that Russia has decided to go for the more aggressive aspect to see whether they can push back the Ukrainians from some of the things they've taken, or at least halt their advances at the moment. Now, that's obviously quite a troublesome situation because the best kind of scenario from a world safety point of view is a quick, easy Russian victory, because Russia has these nukes, and obviously that has an impact on any possible discussions on what happens if the Russians really lose this war quite badly. If you say destabilization of the Russian elites, if Putin gets into power, who replaces him? What does that do for the whole country, etc., etc.? So that's a story worth watching. The next one to look at is inflation. South Africa's inflation number come out this week. We had a slight drop, down about 0.2% or so, but it's still in the mid sevens. Okay, we were hoping for a bigger drop, and this is an important factor to look at, because unlike other parts of the world, South Africa's inflation expectations are not quite as accurate. We talked about that before. What really drives long-term inflation is when people start to expect inflation to be high, because then what they do is they ask for wage increases every year of a certain level to accommodate for inflation. They ask for price increases that accommodate for inflation. Those things tend to make a small supply side shock become embedded in the economy. In places like Europe and North America, because of their success over a long time in fighting inflation and keeping inflation very, very low, they don't need to basically worry as much about a short-term spike causing a long-term change in expectations. So for instance, the US right now, inflation is above 8%. But if you had to ask the average American what they think about the inflation rate for the next 10 years, it's going to be below 4%. It's a big differential between what the actual inflation rate right now is and what the expectations is going forward. If we as South Africa sitting at an inflation rate that was as high as the US, for as long as the US, we'll be seeing a huge, I'm talking about significant change up in the expectations going forward. So we in South Africa have to fight inflation a bit more aggressively, even though inflation rate at the moment is not quite as high as, for instance, Europe or North America. So we saw the Reserve Bank come out with a 0.75% rate hike, and I'll talk about that more in a second, in order to fight inflation. Now, another factor about inflation in South Africa is the fact that it is much more focused on things like energy and food, okay, than other areas of the economy. Which means what? Energy and food are the two big inputs into the POR's inflation number. So even if inflation overall is like, say, 7.5%, if energy and food are 10-20% or so, we can see the POR's inflation rate be significantly higher. Remember, inflation is like the temperature. You can't take the temperature of our entire country. There's an average temperature for South Africa, but some parts are colder, some parts are hotter. There's an average inflation rate in the country, but some parts are higher and some parts are lower. And parts that are happening to be high at the moment are the parts that affect the POR most. Things like food, things like energy, which is electricity and transport. Okay. That's going to be very destabilizing to the economy going forward, because what it means is that the poor who have the least ability to absorb price increases are getting higher than average price increases coming through. That's going to impact the ANC in 2024, maybe next year. It's going to impact also companies that employ a lot of lower income workers. We've already seen that happen in the mining sector, where we've seen negotiations occur around increasing wages to accommodate this high inflation rate. And over time, if enough people do that, if enough employers accommodate high inflation under high wage demands, that's going to effectively cause inflation going forward. So that brings us to the last bit of a thing, which is our deep dive for this week, which is going to be interest rates. South Africa raised interest rates by 0.75%. Okay, that's a pretty high number. We had gone down to the 0.25% rate hikes or adjustments more recently. Usually we were about 0.5%. 0.75 is above what we've been doing more for the last little while. Why is this important? Because the Reserve Bank has to be aggressive to try and fight inflation, because like I said, inflation expectations in South Africa are not as firmly anchored as they are in places like North America or in Europe, which means that if we see inflation for a smaller period of time, say a year or two, be at the 8% level or the 9% level, that's going to become much more firmly embedded in the economy than it would be in Europe and North America. That means we've got to act more aggressively. The second thing is that because we are an emerging market currency, a well-traded currency, if we don't go out there and hike interest rates as the market expects and try and match at least what the US is doing, the US, by the way, also hiked by 0.75% yesterday. What's going to happen is the yield in our market is going to be lower than the yield in the US in relative terms. So let's say a couple of months ago, it was at like say 2 or 3%. Now it might be down to say 2% or 1.5% because of the fact that we are not raising interest rates as aggressively as they are. If we don't raise interest rates aggressively and our yield falls, the rand will weaken relative to the dollar. The rand gets weaker. What happens next? Our imports will become more expensive, because the rand needs to basically match up to the fact that it needs to still buy the same amount of dollar worth of goods, because that's the price in which things are measured internationally. But the value of the rand has decreased, so you spend more rands. That increases inflation pressures in the country, and that eventually causes the Reserve Bank to go off and effectively increase interest rates anyway. So you'd rather push it up right now, up front, instead of just waiting a bit of time. Now, we were not the only country in the world that is looking at inflation and interest rates this month, or this week rather. We had Turkey come out, and they basically cut interest rates. They have an 80% inflation rate, 80% inflation rate, and they've cut interest rates. And what has that done? It's mean that their currency has weakened even further. I've talked about this a number of times in the past, but the Turkish currency has been some of the worst performing currency in the world, especially for a relatively advanced developed economy. Turkey is a larger economy in South Africa, more people. It's a wealthy economy in South Africa, and the people make more money per person than South Africa. It's a large economy. But their currency has gone from about 3 to the dollar in like 2015, 2014 to over 18 to the dollar in 2022. So about 6 times weaker in a period of 7 years. Why? It's because they are engaging in some really loose monetary policy, dropping interest rates when inflation has been rising. If they are going to continue to do that, expect their currency to weaken. If we in South Africa try to follow the same kind of example, we try and buck the international expectations or market expectations around interest rates, we would also see our currency weaken. If we were to try and cut interest rates right now, we'd also see it weaken like the Turkish have weakened. So that's an important factor to consider. Other places in the world that have done something about interest rates, we talk about the Swiss. They've come out and raised interest rates from negative to positive, 0.75 up, from minus basically a quarter to about 0.5% up. So they basically no longer have a neutral or negative interest rate policy. We've also had the Swedish do the same thing. They've increased interest rates as well. They weren't negative, but they've gone to the just below basically 2% at the moment. This is something that everywhere in the world is doing, and places that don't want to raise interest rates by the 0.75% the US is doing can expect to see that their currency is weakening, okay, at least in the short term, because the US remains the strongest economy in the world in relative terms. It remains the strongest currency in the world in absolute terms, and if you have that strong, powerful currency giving you more return, and your weaker currency is not matching up that move, you'd expect your weaker currency to get even weaker over time. Okay? Now, what's going to be happening going forward? The news we have from Jerome Powell in his speech says that he is willing to inflict pain on the economy. He's willing to see the unemployment rate rise. In fact, he expects the unemployment rate to rise if basically the economy slows down, as it needs to slow down to fight inflation. This means that we are going to see the US continue with this rate hiking point. Now, does that mean that the US is not going to buckle? I don't think so. I think it eventually will buckle, because when we have 8%, 7% inflation rates, you need to get to 8 to 7% interest rates to match that up. If you don't do that, if, for instance, say next year the US interest rate is at 5%, but inflation is at say 6.5% or 6%, it's lower than now, but it's still negative. That doesn't really work out long term in terms of basically fighting inflation and getting it down to the level that the Fed wants it to be at 2%. If the Fed wants to really get inflation down to the 2% target like it talks about, we should see inflation rates basically being matched by even higher interest rates. So if the inflation rate is 8%, maybe the the interest rate should be 8% or above. Okay, that is what you'd expect to fight inflation. I don't think the Fed will be willing to do that, because yes, they are willing to incur some pain. They are willing to slow the economy down. They are willing to see stock markets fall. In fact, stock markets falling is one of the most positive things that they are seeing. They actually find it quite negative if the stock market was to rise when they make these rate hike announcements. When we have basically a bit of pain like we have right now, they are willing to continue. But should we have a serious recession, should we have unemployment spike up to say 8, 9, 10%, I do not think that the Reserve Bank of the US, the Federal Reserve, will have the constitutional courage to maintain high interest rates in that environment. They are more than willing to incur some increase in unemployment, because the unemployment right now in the US is very, very low. And basically they are going to raise interest rates, but not to the level that inflation's at. But I don't think that'll be enough to get inflation under control. And I don't think they're willing to do those really dramatic steps that are required. Like I said, 7, 8% interest rates. They might go to the mid 4s, like 5, maybe slightly above 5. But I don't see the US doing like 13, 20% inflation rates, like also interest rates like they were doing during Volker's administration. Now, one final thing to talk about, which kind of contradicts some of the stuff I've said before, is the fact that by doing that move that the US has done recently, by raising interest rates by 0.75%, they've broken in a very important trend. For the last few decades, every single rate hiking cycle has always peaked below the last one. So if this cycle was 5%, the next one will be peaking at, let's say, 4% or 4.5%. There's been a steady drop in interest rates in the US over several decades. So they've been up and downs, but the downs have been lower and the ups have been lower as well. If the Fed basically continues to raise rates, they'll be seriously breaking this trend. Already they're breaking the trend. We are seeing interest rates basically back to what they were at the last hike, at the last high. We already are seeing that they're breaking a trend that's gone on for several decades. Now, why is this important? Because the market is not pricing this in. If we are pricing this in properly, we'd see things under a great deal more pressure. So I expect the market to pull back even more from here as the Fed keeps its basically forecast for its rate hikes quite high. But I do not believe that they will keep it high enough, long enough to control inflation, and eventually they will break and we will have another spike up. So it might be if you're looking at this from a point of view of an investor, it might be an opportunity for you to see prices that are reasonably attractive and have them be an opportunity for you to buy, because I don't think this is the final saga in the Fed's rate hike cycle in order to fight this current bout of inflation in the US. Okay, that's it for me this week. Thanks for joining me, and I look forward to seeing you guys again next week. Cheers.